All right, so that should be recording as well. All right, well, welcome to tonight's webinar. We're going to talk about limited risk reversals, and we're going to talk about a couple different things. We're going to talk about how to use limited reversals, why to use them, exactly what they are. You probably heard me talk about them a lot in the trading room. This is something that if you're not familiar, if you've kind of come in recently to the trading room and you've heard me talk about limited risk reversals and you don't know what they are, then this is a good webinar for you. I'm also going to bring this in. I'll give you a couple of the recent trades that I've done with these and why they're working, why they've worked pretty well the last few that I've done, and then also we'll talk about today's. We'll talk about a couple of the trades from this week using option activity. I will give you my take on option activity the next couple weeks, which I think is important to go over as well. And I'll also just give you a quick state of the market for a quick 5 minutes or so. So, risk disclaimer, I'm not going to go ahead and read this. Everything tonight that we go over is just for information purposes only. And that's it. I'm not giving any advice or any recommendations, anything like that. It's just for information purposes only. All right. So, my background, I think I see just a ton of members in here. So, I think you all know my background. Founded Tribeca Trade Group. It's now 2 years ago. I think it was March 2 years ago. So it's been 2 years. We've made some nice strides. Made some perfected some things. Especially, I just rolled out the live Twitter feed, which is actually really nice and allows me to kind of send out some trade ideas and put a little detail. Just very easy to communicate using that method. Before I was using text messages, and you can't really put too much in text. You can't send a chart in a text message. So that's really helping. My background before that I was an institutional trader at Bank of America Merrill Lynch for a number of years. I really kind of rely on my background a lot. Traded through every type of market situation I think that's out there. Traded through the flash crash. I traded through 2007 to 2009, which the volatility I still think was nothing compared to what we saw. It was pretty interesting a few months ago when we saw the VIX go back to around 50. But we were in a sustained high volatility environment for a while. And every day, just a different type of volatility. I made reference to that in a tweet a couple weeks ago, just talking about how that volatility in 2008, 2009 was a complete different story. We're sitting above the 200-day moving average in an uptrend now. And yeah, things got a little dicey there for a couple weeks, and I think we're not out of the woods completely, but it wasn't anything compared to, hey, when you walk into work, you don't know if you're still going to have a seat. That was volatility. Every day you come in and you don't know what's going to happen, whether you're still going to have a seat to work in. So a number of other things from that time frame. But anyway, that's my background. My Twitter handle is @CFromHertz. Let's go through just a little bit of a market review. I call it "What Do We Know?" And I like to just kind of start with an S&P chart. So we'll wait till Thinkorswim brings that up. How's everybody doing, by the way? How's everybody doing? I want to make this as interactive as possible, by the way, as I start going into the subject of the meeting, which is limited risk reversals. I want you guys to ask questions so that you're getting as much out of it. Mr. Webb Begol is also joining us tonight. He's not feeling well. That's why I didn't introduce him in the beginning of the webinar. He's under the weather, so he's nice enough to kind of to join us tonight while he's not feeling well. So once we start talking about limited risk reversals, I'm going to bring him on, and he can add to anything and more importantly, correct me when I'm not making when I'm not saying something right. So we'll get into that in a minute. But just wanted to go over kind of where we are with the market. I've actually just drawn this new trend line up here for the S&P, and I know whenever I start with the S&P, I do think it's most important. It is the 500 largest companies, in the U.S. But I think there's also so many other things that are going on. Specifically yesterday's market. We had a lot of movers. We had a lot of sectors that were up 2-3%. So you kind of come in. You could come in not really looking at what was going on yesterday and say, oh, geez, we have a really boring market. The market is really range bound. I think we were up like 20 basis points, but as always, there's a lot of there's a lot of moving parts and a lot. I mean, just like today, unfortunately, was to the downside for a lot of sectors. But just looking at today's leaderboard, you just had a lot of big movers, and not just in stocks as well. A lot of commodities were continue to move around. Bonds were down big today, but the semis were down 4.4%. So even though the S&P was only down, futures are reopened. I think they're up, or they're basically flat. But I think the S&P was just down about 0.5% today. But semis were down 4.4% today. Consumer staples were down 2.9%. Home builders were down 2.9%. So it just kind of shows, and then the banks, which, are interest rate sensitive, actually got a little bit of a rebound, up 1.8%, were the bank ETFs, which we did see some call buying, by the way, in KBE yesterday. So maybe somebody was thinking that they were finally due. But nevertheless, only down 50 basis points. Just so if you look at my point here is that if you just look at the averages, they're not picking up what's going on under the hood, and there's a lot more volatility that is taking place. There's a lot more volatility that is taking place within sectors and within individual names. Still, it's good to look at the overall pattern, which is why I have it up. And so we're coming upon, we kind of hit the brakes a little bit the last couple days. We really haven't had a big intraday move. I think a lot of the move has been a lot of the moves have been taking place overnight or pre-market rather during the trading session for the major indices. So I think that's something that's a little bit different for now. We'll see if that changes. Yeah, I mean, I think it's also, I'm going to talk about a few more bullets, but, I think right now you take what you can get. The overall trend, I think, we're still where we closed today. We didn't violate any of the short-term moving averages. That's why I have the short-term moving averages on my charts. We definitely, we retook them, including the 50-day moving average just a couple days ago. So you could say that the short-term trend is still up, even though we were down. We have a red candle. We kind of fell right into that support today. So hanging by a thread, I would say the short-term trend is up. The medium to the long-term trend, you could see, certainly we're above the 200-day moving average, but I would say that the midterm trend is sideways. And I think you really have to come to terms with that. Is the long-term trend is still up, which I define by the 200-day moving average. But, we're just trying to get above this area. And I think once we kind of get above maybe 2,800 in S&P futures, I think once we get past this hump, you could say that we're back in an uptrend. But also when you think about it, right? I mean, 2017 and the beginning of 2018, I mean, you remember this in 2018, this got a little bit ridiculous. I mean, we were way overbought. So when the market really gets ahead of itself, it does become dangerous. And there's no doubt you want to ride this trend for as long as it lasts, but it gets a little bit dangerous when we get that overbought. So I kind of think in the grand scheme of things, we kind of had this coming. We were due for a correction, especially when we get way ahead of our skis. Now, we almost came out of it, back here, and this was definitely a little bit tricky. We ran into some overhead resistance. I thought we were going to push a little bit higher before we would kind of hit, some more overhead supply, but we just didn't get there. We got a little bit above value for the month and kind of fell in between. So, I think that's a takeaway. I think we really, when you examine this from a little bit further back, I think we just got a little bit ahead of ourselves. And if, without drawing any major trend lines, maybe you could just use the 200-day moving average. We're still in this band of an uptrend. We just got, a little bit too far ahead. That was a skiing reference. Yes, you should know all my references by now. So, plain and simple, the VIX is lower than it was. I used the reference of a month ago. Was it 18? But even a week ago or a couple weeks ago, we were in between 20 to 23. So we've definitely come in, and I think that's an overall good sign. I'm not sure if I would expect it, or I'm not sure if you could expect the VIX to go all the way back to like 11 or 12. I don't think that that's normal either. But I think around a 15 or a 16 is pretty normal volatility historically. I still think the historical volatility, which I don't have what the average is over time, but I think it's more like a 17 or 18 is historical volatility. So, that's the environment that normally we should be in. We should have big back and forth moves a little bit. Going up in a straight line is not the normal. My little phrase that I've been calling this market is a stick and move market, where basically, if you have a couple profits for a couple days, being that it is what it is, this is a bit of a mess right now. We're hitting this overhead resistance. You have 3 or 4 days of gains. You have to take some money off the table. It's, we're not just doing this anymore. Just, riding and coming into the 20 period moving average and then, gliding back up again. This is different right now. So you have to change your trading style with what the market gives you. You can't continue to play the same strategies that were working in different, in different market time frames, not time frames, but scenarios. So I call it a stick and move market. I think you have to take profits, especially with your shorter term. If you're trading both longer term options as well as shorter term options, you can't just let these things stay on your books. You got a nice profit, you got a double, you got a triple, and there's management too. You don't have to completely take the trade off, but you could do the roll out and up, which we've been doing a lot of. As well as just taking trades off and waiting. I said this in the trading room a couple days ago. You don't have to chase a lot of trades. I think you're going to get a red day from now and then. I said this 2 days ago. Excuse me, I said this yesterday. I said I didn't put on any new trades yesterday, any new swing trades, because I said you're going to get a chance. I said I don't know when a red day is coming, but with this environment, you're going to get another one. Sure enough, we got one today. So there's no need to really trade. When we're looking at option flow that's hitting the tape, I know that there's sometimes you feel that, oh my God, that's a good looking trade. I want to get in it. It's starting to move. If you're a little bit patient, you can get into a lot of these trades that we've been seeing on the tape recently. You can get them on a discount if you're patient enough. I mentioned sector separation, pockets of strength and weakness. There's certainly the commodity names have been ripping. It's really nice to see. I think one of the differences or one of the takeaways from when we hit the 200-day moving average back in the beginning of February and when we rallied, I don't think we had a lot of participation in different groups. I think it was mainly tech. It was mainly tech, semis. Those were the ones. The internet ETF, which was a great winner, and is still showing some nice strength. But this FDN, all the way right around that time frame, hit a 52-week high, and then it fell apart a bit. But it still looks pretty good. But I mean, these were the stocks. I mean, all those stocks that, the tech stocks, people jumped into those like crazy when we went back to the 200-day moving average. So the problem was up here. Of course, hindsight 2020, but I don't think we had very good participation. I think it was tech by far was leading the way. And then once that cooled, there was nothing really to kind of pick up the pace. This, I think, is a little bit different. Again, we had some volatility in the home builders and the semis today, but energy is really participating now, and so are the material names. In addition, just as I was showing the chart of FDN, so is technology, and especially the software names, the smaller business names, as I call them, the application, the enterprise, the infrastructure software names have been really strong as well. Those small cap names, and a lot of the charts all look the same. Your Salesforce, your Workday, your Vive, so there's I could rattle off like 10 different names that the charts look so similar. So some nice strength in this market. Does that mean that we're definitely going to go higher? No, but I think it's got a better chance. I think the market has a better chance now that more sectors than just one or two are participating. So we'll see. I think that's the most that we can really say right now is we'll have to see if we can maintain the short-term moving averages, and we'll see if we can power through this. So that remains to be seen. The next area that I want to talk about is just option activity, because we do that on a daily basis. We read the tape, kind of look to see what sectors they're going after. It's really a good proxy for both risk. If traders and institutions are taking risk, or if they're sitting on their hands and buying protection. And it's also great idea generation. That's probably the number one reason why I use option activity. But I call it a dead zone right now. Why do I call it that? So I really need to define that. Just putting dead zone, that you're probably thinking a bunch of different things. But I think it means a dead zone because we've got earnings. We've got a whole bunch of earnings reports that are coming out next week, the week after, and you see just a lot of option activity, and they're buying. A lot of times they're buying, and they're buying the expiration, like the day or the week right after they report earnings. So you don't really know what they're doing. You don't know if they're just hedging a short position, which a lot of times that's what they're doing. I think they could always be buying calls to hedge positions, but they seem to be doing that a lot more around earnings season, which kind of makes sense. It's a big event. Earnings season, there's big jumps that happens. I think everybody knows that there's big gaps. A chart could look great until it reports earnings. A chart could also look horrible until it reports earnings and it moves up. So it's a make or break event, and there's a lot of people really want to. You have to think about. I always think about this in terms of your own portfolio. If you're sitting with a long position and you've got earnings in front of you, you're going to want to protect that position to some extent, or maybe take that position on. If not, you're kind of just rolling the dice a little bit. So, and a good example was Western Digital. We looked at this trade. So a lot of times you'll just hear me say that in the trading room just over and over and over again. Western Digital. Here was the trade from yesterday. It went up aggressively. It was swept. There was two orders that went up. There was both the Aprils. There was also July's. I mean, this was a nice looking trade. July 85 calls for 880. Pretty sure it was an opening trade. Yep, sweep opening on it. Big time trade, $750,000. But you look, and I know it's not saying it here, but Western Digital reports next week. So what are you going to do with it? You don't know their motivation for putting this trade on a week before earnings. 426. And what did Western Digital do today? It got creamed, right? It was down to, of course, all of the chip names and names in this space got beat up. Actually, the chart doesn't look bad. It doesn't look like it really lost that dotted line that I've got drawn there from previous. It still is not fired off a 52. It's not an MACD crossover. But so you really have to be careful, and I will tend not to trade if I see a name reports. Again, you have to ask yourself what you're getting into the trade for. Now, normally, if it was a July trade, and let's say it just reported earnings, I think that would be a great swing trade trade that I would maybe structure a little bit differently than buying the right at the money calls in Western Digital, because that's that's an expensive option, 885 per contract, but you know, anything could happen for that for the earnings event. So that's why I kind of so long explanation there, but I think it's a really difficult time to swing trade options. I think there's a lot of good trading that you could do. It doesn't mean that there's no trading to be done. It just means that some of these trades that we see go up on the tape, you kind of have to take with a grain of salt that it's a lot noisier with the earnings event right in front of it. Who knows? And it could also be, I'm talking very negatively because I always think about the risk first. But it could be somebody's really speculating and thinks that Western Digital is going to have a good earnings report as well. But again, to me, it's an unknown event. All right, so that's that. Any questions about that? Any questions about that? I mean, so there's certainly some really good trades, and again, I'm going to get into them with the limited risk reversal, which is the subject of the webinar tonight. But all in all, I go through this every quarter. I generally try to trade a little bit less during earnings season. There are certain trades and you've seen me put on some trades that are basically looking for a run into earnings, which I think is also what we're seeing now for the FANG stocks. So there's definitely trades to do, but as far as putting on a bunch of like sizable swing trades, I shy away from that until at least we get through earnings season, and then you can kind of structure trades out a little bit further. But again, I talk about this every earnings season. It's just very noisy. So let me get through. I'm going to talk about the 3 option trades in a minute as we're talking about. I'm going to talk about I think the 3 best option trades from the last week. So I'll get to that, but I want to get into the subject of the webinar because it's already about. I always spend longer than I think I'm going to do with this. So I want to talk about what a limited risk reversal is. If you're not familiar with this term, it's pretty simple. It's not a complicated option structure, but I'm going to go through all the advantages and why I think it's a really good strategy for this type of market. But it's similar to replicating a stock position with leverage, except that your downside is capped, right? A lot of people talk about risk. You hear the term risk reversal all the time. So always kind of start with the more simpler concept. A risk reversal, let's say a bullish risk reversal, and we see these on the tape a lot, which I view are pretty good option signals. It's when somebody buys calls and they're selling puts. That's pretty much replicating a stock position with leverage because they've got unlimited upside potential, which is what you have when you buy stock, and you've got full downside risk down to 0 when you sell puts. So that's what a risk reversal is. A bearish risk reversal is the opposite. You're selling calls and you're buying puts. There you have unlimited risk because the stock could, of course, go to infinity and beyond. And your risk and your profit is capped all the way down to 0 for a bearish trade. So that's what a risk reversal is, and that's important. So I kind of shy away a little bit from those trades because I think anything could happen, of course. So if you're doing, for example, a bullish risk reversal, you could have a big loss on your hands if something bad happens, especially if they come out with an announcement, what have you, some type of bad news. You could really get hurt with that, especially when you're dealing with that leverage component. What I like, and Webbegoal has, really put a lot of research into this study. So, perhaps when Webb is feeling a little bit better, we'll kind of go over. I know he's done a lot of presentations on this, and he's talked about the different structures that you could do, like how you can kind of mess around with your strikes, put your strikes a little bit, out of the money, in the money. But basically, what it is, a bull limited risk reversal is you're long a call, so you have a limited upside when you do this, and rather than short puts, you're short a put spread, right? So this way you're capping your downside, right? So and that's how we kind of coined the phrase risk reversal, but a limited risk reversal because your risk is limited, and you should know exactly what it is every time you structure a trade. On the other hand, so that's a bull limited risk reversal. A bear limited risk reversal is the opposite. You're taking a bearish stance. You're buying a put, and you're shorting. I don't know why there's a plus sign there, and you're short a call spread. So that's how that works. Just to go back to this previous slide, what's nice is a lot of different trading software will let you see how this looks. And it's good to always talk about the option profile here. So in this sense, what you have is your option profile, and it gives you a sense of where you're going to make money and where you're going to lose money. So this is a trade that I did today, and very small. I just did this in a one lot. So I'm going to talk about the risk management in this and why I just did this for a one lot today, which is small size. But my maximum loss, and you could see the trade that I did here. I guess it doesn't show you the strike, but you could go into Slack and you could go into the trades channel. I think this was one of the last trades that I did today. And what I did was I went long the June 240 calls. So Constellation Brands, STZ, they report. I like to basically pick out the expirations based on where they report earnings. So I don't want to cover when the name reports earnings. I think Constellation Brands reports at the end of June. So I chose the June expiration and I went long the 240 call and I spent 251 for that. And I financed part of that outright call by selling a put spread and collecting 222. Right, so my total cost for this, out of the pocket on the inception of the trade, is the 251 minus the 222. Right, so a little bit less than 30 cents. So 29 cents. So I try to structure these so that they're pretty close to zero cost. Well, not necessarily. I mean, yes and no. Better have a good feel for the company and should be trending stock or not. Yes and no, and I'm going to get into that. But basically, that's how I decided to do it. And you could see, so your loss, if it happens to go below the, what is it, what did I say? If it goes below 225, that's your biggest loss that you could have. And you'll go ahead and you'll lose $529, which is exactly what I put. And that's your maximum loss. That's all you could lose. Your break even is here, basically right where the stock is. And from here to, from the time of the upper strike in the short put spread to the long strike, to the strike on your call side, you're basically flat. Here is where you really start to make money. And what's really nice about this strategy, from 230 to 240, nothing really happens. So there's advantage. There's a big advantage to that, and there's also a big advantage to once you start to get above 240, your profit really starts to pick up because not only are you making money, you're basically making money on both sides of the trade. So that's where you want to be. You don't necessarily want to be down here, right? But we've determined what our risk is. Okay, so let me go through a little bit more about this. Oops. So why do we want to be doing this trade? So first of all, there's a few different reasons, and Webb, whenever you like, feel free to chime in and let me know if you think differently or if you want to add. But you're defining your risk every trade. So why am I putting these on, some of these just for a one lot? Because you could actually make a lot of money. So you're defining so every one of these trades, And the nice ring about these trades have a nice ring to them, because every time you put one of these on, let's say it's just for a one lot, you're only risking around $500, which is kind of how I like to structure the trade. That's it, and that's all you can lose. So now, of course, there's going to be times where, and you could put this on as many times as you want. You want to put on a 5 lot. You're saying basically I could lose $2,500. In option trading, I think it's very important to do that. So I think part of the problem when you're dealing with these types of trades, in any type of option trades, you have a tendency to risk too much money in short-term option trades. I see it with especially newer option traders all the time, because a lot of times it is a little bit confusing, because we see short-term option flow on the tape. That's the majority of what we see on the tape. Aggressive, they're either buying at this point, which May is going to be front month in a day, but they're buying May mostly, they're buying June. The problem with that is it is so volatile, and it's easier said than actually done. But I say to traders all the time, if you're putting on a May or even a June option position, you have to be comfortable with losing all the premium, because you can't stop yourself out, right? It's not like a stock trade. A stock trade, so going back to the we could look at this STZ chart. So if I were to put this on in cash, right, I would say probably I would use this blue line as my stop. I would probably use, because I do have that I do run a systematic cash trend portfolio where all the stops are built in, right? So it's pretty black and white. I've got that programmed using Bloomberg API, and once the price goes below, I've got all of my stops are based on moving averages. And if it goes, like in this sense, I would use, if I was long STZ stock, I would probably use the 20 period moving average. If it dips below there, it's no longer in that sharp uptrend, and I would get out of it. Or another one, just because I know this is hanging at the 200-day moving average, KWeb, the Chinese internet ETF. I would use the 200-day moving average in stock. If it breaks the 200-day moving average, get out. Small loss, right, for a stock position. Only down. That 200-day moving average is down $1.30. So that should be a small loss, as long as you stay disciplined, as long as you follow your rules. However, for options, you get into a May position in KWeb or an STZ, there's no stop. The stock drops $1.50 in a May option position, you're done. You get in, let's say that the option price is, let's say it's $1 out of the money, and I don't have the option chain in front of me, but let's say the May option chain, $1 or $2 out of the money is cost you $2, right? And the stock goes down, $1.50. So down, now the stock is down here. What's probably going to be your price of your May option that you just bought for $2? Probably about 70-80 cents. So what are you going to do? You're going to stop yourself out for more than a 50% loss? That's not how stops work, right? I mean, stops are supposed to keep you out of big losses, right? So if you're going to play the game where you're going to trade, if you're going to trade May or June options at this point, you have to be comfortable with. There's no way that you could stop yourself out and get out with, because what'll happen, let's say you use a stop right here. What, you're going to stop yourself out for 25% of that option position, and then the next day it's going to rally, So you just can't, does that make sense? Have you guys been in that situation where you're in a short-term option play, which I view short-term as May, and you buy it for $2. The next day it's down to $1.70 because the whole market has gone down a little bit. You take the thing off because you're like, oh, geez, that's a 15% move. You stop yourself out. 2 days later, the stock price is higher than it was 2 days ago, and that would have been a huge winner, right? So so the point is, and it's a very important point for any level of option trader, but especially new option traders. They make that mistake all the time. If you're going to buy that May option, there's no stop. There is no stop. It doesn't work that way. That's not how option trading works. If you're messing with short-term option prices, you have to be comfortable with saying, because sorry to say, but you're never going to be a profitable options trader if you get chopped up like that and take the position off if it's down 50 cents the next day. You're never going to be able to time it. Because again, when you're dealing with that type of trade, you have to get two things right. What are the two things that you have to get right? I'll let you guys answer if right. So not only do you have to get the direction right, which is hard enough. We know that, right? That's not, but you got to get the time right as well. So it's better. So in my opinion, so what I'm getting at, you put on an option trade if you're going to play with the short-term options, if you're going to put on a May option trade, you might as well just leave it on to expiration, because a lot of times the stock will come back. Granted, we don't have one of these moves, right? If we have one of these moves, you put your trade on here, and we start to do one of these waterfalls, a lot, then you're sunk for the month. All right, so let me get back. So this is why I think the limited risk reversal is really helpful, because again, you have to put this in the context of, if there's no stop on 1 to 3 option prices. You put these on, but you have to be very cognizant of that risk and say, okay, what am I willing to lose? So for me, some of these trades, and again, given the way that the market is moving, which is choppy as hell right now, I have to be comfortable with, we could get some more volatility, because nobody knows, right, in the short term, what we're going to do. Nobody has a crystal ball that's going to tell you. I can think what's going to happen, and especially with my long-term stock positions and my long-term option positions, I could get out comfortably if we start to move back down and come back. And I don't know if there's going to be another retest of the 200-day moving average. I hope there isn't, for the way I'm positioned. But on all of my stock positions, I've got programmed stops in here. So as long as I honor them, and as long as I click the mouse, I should be fine with my, barring anything, of course, tail risk. But I should be able to get out of my stock positions pretty easily. But for option trades, again, if you have those short-term option trades on, it's going to be, you're going to be taking losses if we get a move in the overall market, bang down to the 200-day moving average. There's no question about it. If you have some of those May or June positions, right? And that's a risk that you have to be comfortable with. That if we have a big sell-off like we had here or here, those May and June positions, you're 1 or 2 days, they're going to go from, $1, they're going to be trading at 20 cents or 10 cents. All right, so that's why I like this strategy. And it's not a buy and hold strategy. The other thing I think that gets lost, again, I'm really preaching tonight, but the other thing that gets lost on traders when they buy these June or July option contracts is they are a trade. They are not an investment. So you really want to be in and out of them pretty quickly. But if you structure them right, and I think, again, the limited risk reversal can keep you in the trades a little bit longer, where you don't lose your shirt. So if we happen to chop around, so basically, I covered this. Only put in what you want to risk, and a little bit of a scenario analysis. Let's say for a bull risk reversal, because it's a little bit easier to explain. So I've got a number of these on. you can kind of look to see what I'm doing here, and I don't mind sharing some of these positions that I've gone on. But a lot of them are working pretty well because I put them on. I timed it pretty well. But if the price does go down, except for maybe and it's good to talk about one that's probably not going to work. This ITB that I put on back on April 4th, where I'm long a call and short a put spread, I'll probably lose the $500. But on a lot of the other ones, I've made up for it by having some huge winners. So the price goes down. Yeah, you'll lose the premium that you collected from the put spread. You'll lose the premium that you paid for the call, but you're capped to the downside. So every one of these, if you look, the major point is, what am I risking? I'm risking $510. Now, here's the other thing that's pretty nice. If the price stays the same, and I had a number of these that I put on, and some of them are already off the sheet, but if the price stays pretty much exactly where it is, you go back to this profile. Oops. Whoa, too far back, too far. If the price stays exactly the same, what's nice about this is you don't have to worry about theta decay when you're just long an outright call, right? Which can be very frustrating, especially when you're dealing with short-term options, is that if the stock, you kind of feel a little bit defeated because sometimes the stock doesn't go down. Sometimes the stock actually goes up a little bit and you lose money. So this is a nice scenario if the market, which I think we have a good chance to, if the market just stays here or goes higher, it's kind of a non-event for your trade. But better than losing, $2 in premium or $1.50 in premium, whatever. So that's the advantage. Of course, if the market takes another big move to the downside, you're in this situation. But by chance, if it starts to accelerate up, now you can collect the premium that you sold on the short put spread, and now you're also in the money on the call side. So just to kind of give you an example, if you go into the trades, these are a couple examples, and I don't have the pure dollar amount, but this one I managed, workday. I put this one on. This was a big winner on the call side, and I managed, there was big premium to collect on the short side. So this was, so some of these you could basically get nice doubles or triples if you get this. Whoops. Right? Once the price starts getting up here, now you're dealing with a double or a triple. And again, going back to what you need to do, Webb's hand is raised. Yes, Webb. Going back to what you need to do in yeah.
Oh, does it work? Can you hear me?
Yeah.
Okay. So one question that I used to get all the time on the limited risk reversal that I think you can address as you've explained it is, okay, so in the example limited risk reversal that you gave, STZ, I think it was, the call itself was like $2.50-ish, and the limited risk reversal in total, you were risking 500 and something.
Right.
So the question I used to get all the time was, well, if my max loss in the limited risk reversal is going to be 560, or my max loss just buying the call is going to be 250, then why don't I just buy the call? Like, why should I be going to limited risk reversal instead when I still am buying the same call, right?
Right. So it depends. Just as we were talking about with, I've got a slide over here. There's a little thing called theta decay. So I think it really depends on I like the ability where if the stock doesn't move, The difference is with one of the points that I made is that if the stock doesn't move by June expiration for whatever reason, you're going to lose that outright call. In this scenario with the limited risk reversal, instead of losing that 220, you're going to be basically flat. That's where I think the advantage is. Do you agree?
Yeah, I totally agree. I think there's actually a list of advantages. I think that's certainly one of them. In the exact example that you gave, I think if it expires in that band of 230 to 240, you lose your like 29 cents. That was the net cost of the original trade to put on.
Right.
But that's negligible, and if you can get it close to a zero cost to put on, then it is negligible to zero. Or sometimes I can put them on for a credit, which is what I try to do. But my other point is that the additional advantage is that if you were to just buy that call, that 240 call in STZ for $2.50, your break even on expiration is 240, 250, right? Like it's $2.50 above the strike.
Right.
Where in the limited risk reversal, you're in profits. As soon as you're above 240, you're in profits. Well, okay, technically above, as soon as you're 240 and 29 cents, you're in the profit range. So if we were to expire at 242 and 50 cents, if you had just bought the call, you would have broken even and all that stress for nothing on expiration, right? And with the limited risk reversal, hey, you just made $250 per one lot. So that's a secondary advantage. It's the theta decay protection that you get. But it's also lowering the break even. It's making the break even a bit more advantageous as well. So that's an additional advantage of the limited risk reversal in my mind.
Right. So it's almost. I mean, what we're also trying to do here is also try to replicate a stock position a little bit. So yeah, basically, if the stock doesn't move, you're not going to get dinged by the theta decay. And then kind of, one of the subjects that I had mentioned, or I think one of the topics that I mentioned when I sent out this webinar invite is trading options in a higher volatility environment, right? We know, going back to like what I always like to start off with a webinar is, what do we know? We know that when the VIX is higher than it's been over the last couple months. Now, granted, again, the VIX has come in decently the last week, but you know that your options are going to be more expensive, right? You know that there's one of the components of Black-Scholes option pricing is implied volatility. So the higher the implied volatility, the higher your cost of an option is. The other thing is, once we saw this a bit, I guess at the beginning of the week and towards the end of last week. You also have when that volatility does come down from like that 20 mid-20s to where it is now, your option price is going to go down, even though the stock didn't move. It's called vol crush. Sometimes you'll experience that with, after an earnings event as well. The implied volatility is higher going into the earnings event. And then once that event comes out, you get what's called vol crush, and all of a sudden your stock price may not have moved, but because that implied volatility is much lower, the price is going to be a lot lower, and you automatically lose, right? You don't collect 200 by going past go. You actually lose 200 by crossing go. So that's why you're taking it when you sell that put spread. You're automatically building in a little bit of a buffer for right now a little bit of heightened volatility in the option prices. And the case of vol crush, you're putting in a little bit of bumper room for yourself too, because automatically on that vol crush, again, the price, let's say just in a couple days, you spent 220 for that call in STZ, and the price will go down to like $1.70, $1.80 on the vol crush alone, right? It's just part of option pricing. And then in addition, the thing called theta decay, right? So I spent a couple hours last night making this chart. Took me a long time. I had to get all the lines right and so forth. I'm just kidding. I lifted this off of another website. So you can find this. You can just Google, theta decay, and you could get the same exact chart that I just lifted. I would have cited it, but there's no citing to do other than Google. Um, does it work for? So that's a good question too. But yeah, so basically, so you know that this, again, things that we know. So going back to, and I'm going to talk. There's a reason why I'm talking about May and June. May and June, specifically option prices. But you know that if you're going to be dealing with the May and the June, like this is going to happen, right? So when you do that type of a trade with a limited risk reversal, you don't necessarily have to worry about that too much because it's happening on both sides of your trade. So you're going to get rewarded for it. Okay, so a couple questions. Does limited reversals work only for cheap? Only work for cheap premium. Can you use limited risk reversal on Amazon? Yes, you could use something like that for Amazon. We were talking about Amazon today and option pricing, and unfortunately, a lot of the trades that I'm looking to do right now is for possible run names that are going to run into their earnings print, kind of like what Amazon and Google are doing right now. The problem is that it just doesn't line up well because we don't have an option expiration right in front of their earnings print. They both report, I think, on Thursday. So you're going to have to buy the April 27th calls, and that's not going to decay because you have the earnings event. You've got a big binary event, and therefore let's say you bought a call spread for Amazon, $10 wide call spread, and out of the money call spread. I'm not even going to use real dollar amounts, but let's say you bought an out of the money call spread for Amazon, and let's say before earnings, Amazon manages to rally, and it goes all the way through. I mean, I guess I will show just so you can visualize it a little bit better. Let's bring up an Amazon chart. That's not the right symbol. Okay, so let's say you're looking for a move, a run into earnings, and let's say you decide that it's going to go through and get through the top of value. So again, I'm not going to look up next week's option chain, but let's say you want to buy like the 1580, 1600 call spread, right? So it's $20 wide. The problem is what you normally would want to happen is the price goes through the upper strike. You get rewarded big time. Let's say you put this trade on for $5. Normally what would happen on Thursday before option expiration for a $20 wide call spread is the option price will probably go from $5 up to around $17 or $18. And you'll be able to take it. Now it's not going to go. Let's say that Amazon blows through the upper strike, goes up to 1620, and you're long a 1580, 1600 call spread. On Thursday, what this is going to probably look like, and I'm guessing again, normally, if it didn't have earnings, it would probably be marking at around like $18, right? It's not going to go all the way up to the 20 because you still have time in front of you, but it would be a pretty nice trade if you bought it for 5 and you were able to sell it for 18. Love those trades. The problem is what's going to happen is, let's say that Amazon price does that and goes to 1620. It's way beyond your strike. It's probably only going to value around $12. Somewhere around there. Significantly less. Why? Because you have that big event Thursday night before option expiration. And that's being generous. Maybe it only marks at $8. So it's just not, so you're telling me, right? If you told me that the perfect scenario, you got what you were looking for, you put on this 1580, 1600 call spread, and the price goes up to 1620 on Thursday, you bought it for 5, and it's marking at $7 or $8. Okay, you got a little bit of profit on you, but you got what you were looking for, but because of that big event, it's not going to realize it because you've got just a huge event which is, and again, I think it's Thursday that they both that Amazon reports. But you see what I'm getting at? It's just not going to, no matter what the price does, even that great scenario, if it goes up to 1620, you're not going to be able to you're not going to be able to claim it. So that's the issue. Trust me, I've been there before. I've done I've done these trades. You're like, man, why it's so frustrating. You're like, but the stock is above my higher up strike price. You're like, hey, I won. I got it. I got what I was looking for. But now time is working against you, or in this sense, a big event. So that's why it's kind of difficult. Now, if it where it would be perfect, where it would line up really well, is if Amazon was reporting not this Monday but next Monday. So you could put on that 527, that 427 option expiration. It gets to 1620, and you put that on for $5. You're able to collect your $20 or closest to, if you don't feel like waiting all the way to options expiration, and you're done. You got a beautiful trade on your hands. But unfortunately, Amazon reports the Thursday before the 27th rather than. So that's what I always look for. I try to set up my call spreads for the running into earnings trades, and I usually look for the option the option expiration that comes right before they report earnings. Just unfortunately, a couple of these names that it doesn't line up that well because tomorrow's option expiration, and these don't report till all the way till the end of next week. All right, so that's that situation. So the other thing, yeah, no problem. So going back to do you want to be doing this in a low volatility environment? You can. There's always going to be this. And again, Webb, feel free to kind of chime in with your thoughts. There's always going to be this theta decay. But if we're trading at an 11 or 12 or 13 VIX, your option prices are not going to be that bloated. They're going to be a little bit less. So therefore, think about what you're doing in the option world is, you want to be taking advantage. You do want to be speculating to the long side. I think, you want to be buying option prices when they're cheaper, not when they're more expensive and you can get hurt. So you always want to be in that context.
Yeah, I was going to say that I've actually found that putting on the limited risk reversals recently, and I want to define recently, I would say in the past month or two, I found it actually a bit harder. I think the prime time for limited risk reversal really last year was amazing. That doesn't mean that it's impossible. It doesn't make it a bad trade at all. It was just that you could put on structures that I was doing constantly where you sell a put spread and you would buy two calls for a net zero cost. Like structures like that were working out really well. Now that the VIX has started to rise again and we start to have a bit more uncertainty in the market, and the skew between the put side and the call side is getting a bit more extreme, in addition to the VIX rising, has made finding those really nice limited risk reversal structures a little bit harder. But that again, it doesn't make the trade bad. It just means that maybe you don't get like the perfect structure, but you're still going to do all right. Like the STZ one that you gave as an example, you can do that in this market, no problem.
Right. Yeah, and also so when you go to set up your trades, again, I like to Web structures these a little bit differently than I do. I like to have the stock price kind of in the middle of the call and the short put spread, right? So you have that bumper. You go back to this, right? This will change completely. Whoops. This profile will change significantly. I've got a lot of bumper room. I guess till I get to the call side, I don't have bumper room to the downside. I start to immediately lose money if the stock goes down. But I do like to, for the most part, kind of give a little bit of bumper room um, in the middle, and this way, if the stock doesn't do much, I'm not gonna. I'll I'll lose less than what I would do by buying an outright call. Yeah, so before I get to the next slide, I wanted to touch upon Don's question as well. Don, you have to think about it this way. When you do that, when you're buying straddles and strangles, first of all, you want to be doing that when option prices, when the VIX is, for me anyway, I want to be doing that when option prices are cheap, not expensive. But basically, what you want to think about is, do you want to be buying volatility? That's essentially what you're doing. When you buy straddles or when you buy strangles, going back to what you're trying to achieve. You should always be thinking about what's your motivation and what you think the market is going to do. If you think that we're going to have a huge move in either direction, like a really big move, then sure. Because again, for a strangle or a straddle, you're paying for both the outright the premium of the call and the put. If the market doesn't do anything and we chop around, you get smoked because you have a huge capital outlay and the market doesn't move. Uh, you're gonna lose a lot. But again, every option trade has an advantage for different situations. If you think that we're going to have a dramatic move, doesn't matter. You don't have to actually pick the right direction, as you said in your question. You don't have to know which way we're going to move. But if you're basically you're really going long volatility because you think something is going to happen. So those have worked. Those strategies work, especially uh, those strategies really work well when you're basically outsmarting the market, when the option market maker is not pricing in a big move and you get a big move, right? A lot of the times, like especially around an event, right? Like if we have whatever, like a Fed announcement, right? You know that the option prices are going to be super jacked. They're going to be expensive because you have a possibility of the market really moving in one direction because you have an event. Same thing with options. Same thing. You know that there could be a big move. That's why typically, I don't think like really what the desired trade to do around earnings is to buy a straddle because the option prices are jacked up. They're expensive. So you really need a big move, and you need a bigger move than what the option market maker is expecting, and they know they're pretty good at estimating what the implied move and where the stock is going to move on earnings. So you really have to. You're basically thinking that you're going to outsmart the market maker because you think that there's going to be a big event. So that's that. And again, that's why we're talking about not doing that. We're talking about getting rewarded if the stock doesn't do anything. It's completely different strategy. But again, the danger in that. Sorry, beating this one to a dead horse. If the market does, you do that, you buy calls and puts, and the market doesn't move. Ugh. Okay, so just this is nice because this is the next slide to talk about. Like, when is this a good time to do it? Again, there's a different time to do different strategies. You can't just use the same type of option strategy in any market condition and think that you're going to have a high success rate. There's different strategies for different market environments. So yeah, it helps when there's high volatility right now. And again, go back to the VIX. It's very easy. The VIX is higher than it was 6 months ago, but it's a little bit less than where it was a month ago. Right? So we're dealing with a VIX, in the high teens right now, and it won't take much for it to get back to the lower 20s. You could debate what you think the VIX is going to do next. Shorter term trades. So this kind of also goes into, I mentioned I was going to get to why I'm looking at May and June, because a lot of trades that I'm putting on right now, especially this type of trades, these, where I'm only going out, a lot of these trades, I am only going short term right now. Why? Because they have earnings coming up. Except for an ETF. ETFs, you don't have to worry about that. You could kind of structure however you want because you're dealing with a basket of securities. But Salesforce, I specifically chose the May 11th. I'm looking for a run further for Salesforce, which this trade has worked really well. This is a nice play because Salesforce, if you want to, I mean, you probably know if you've traded some of these names or like Workday or any of these names, they're not cheap options. They're expensive. So selling a put spread really kind of helps you get into the trade and be able to profit from it if it moves in your direction. Just as Webb was saying, you look at Workday, and I don't have the option chain up right now, but I'm guessing that and again, for a lot of these small tech names, let's see if I can find it really quick, or if anybody knows what the implied volatility is, who has it handy. But they're not cheap options. It's not like buying Apple. Yeah, it's 30. It's not that bad. Implied volatility is about a 30. It's not horrible. It's not great, but it's not cheap, right? You go to again, just look at SPY. Again, these are all things that you should be always looking at whenever you buy an option. If you're not, I think you're going to have a tough time. But SPY right now, the implied volatility is 11 or 12. So they're basically estimating it's 3 times more expensive to buy a Workday call than it is a SPY option. Right? You should always be looking at this because you need to figure out like what they're expecting the move to happen. So this really kind of I think helps you discount that high option price. And certainly we've seen certain names that have an implied volatility of 50 or 60. So it gets worse. Sometimes especially like the smaller cap name that you find. So it gives you a really good way to kind of get into names that, now again, I can't make the market maker be tighter because some of these options are just they're wide. So sometimes you do have to kind of stick with the one that's seeing the most volume because of the liquidity issue there in some of the smaller cap names. But this is a nice way to kind of counteract those expensive options. Workday's worked really nice. So now I'm sitting and I could be a little bit more patient because as it's above for Workday, my put, what's the Workday? And I actually rolled this. So and that's the other thing is you could also manage these. So for example, I wanted to ride a winner in this one. And I think when I put this trade on originally, I think I bought a call for like a little bit less than $2, and the call was marking at 390. So I said, hey, right off the bat, I had a real big winner, and the put side is continuing to decay, which is beautiful, right? It's working in my favor. So I still have the short put spread on, I believe, in this trade. And what I did was I took the trade and I rolled it out. And I went from a May position to a June 145. So, that's the whole beauty of this too, is the management. You can, instead of just taking the whole trade off, I said, hey, I think so now that it's moved in the right direction, what I'm looking for from a technical aspect is for Workday to get up to 132. Now, again, that's what I think could happen. Being that I'm dealing with such a short-dated option with May, all it takes is a big market swoon of, we know from recent history that we've gotten those, and I could lose that whole $4. So I want to lock it up. I want to take that $1.90 or whatever that I paid on the call. It's marking at a double. Take it off because it's short-dated. Anything could happen in the short term. And now I taking that money off the table, and I ratcheted up I rolled out and up essentially, and now I'm playing with the house money with that trade, right? So that's what it's all about, is what to do when the trade starts to work, because again, I think that there's more, and I'm hoping that it's got more to go before earnings. So again, this trade is specifically set, and a lot of these trades are for running into earnings. Salesforce, Vive that I just put on today. STZ I went out a little bit further because they report at the end of June. But it's a great way to get into some of these trades And again, I have to be comfortable every time I put one of these short dated trades on. And again, it's why I'm only risking 500 trades for most of them. A couple of them I did add to, you know, which have already been taken off, I think. But there was a couple that didn't work. For whatever reason, there was a little market dip 2 days later, and I actually put on a little bit more risk. So you have that that ability as well to kind of add to the positions. But yeah, it just makes me a little bit more comfortable with dealing with a short-term option trade to be like, yeah, I'm okay if I'm going to lose 500 bucks. I'm not going to be happy about it because but the sooner that you kind of realize that not every trade is going to work and you've accounted for the downside, so for this one that I have highlighted, ITB was down huge today. I'm not going to stop myself out. The most I could lose is 500 bucks. I'm over it. And if it happens to come back by June, you know, it's all is not lost. Because again, I've seen that and I've been there so many times where you're sitting and you're like, geez, I just put this trade on and it's down 50% and the market looks like it's going to go down further. And you take it off and a week later, the thing's higher than it was. So it really kind of helps you kind of control your emotions too when the market is selling off because you're measuring that risk. So just puts you in a different time frame. All right. Any questions? I think that's pretty much all I wanted to cover. Again, I think we could talk hours about how to structure the strikes. I've got a certain way to do it. I wanted to talk a little bit about the best. I did promise to kind of go over the best three option trades for the week. Webb, anything that you wanted to add while we pause?
Sorry. No, I mean, I think you covered everything. I'm in complete agreement with you. Like, we could go on for hours about the different structures, even the different management techniques. But I think you're covering the basics. I think that I just encourage anyone who's interested is like go put one on or go find one, go put one on, and watch how it responds. Watch how it responds to how the market moves, so that you kind of get comfortable to how this thing kind of acts. Like I always feel like whenever you're dealing with a new option strategy you've never done before, like a butterfly or even a spread, if you're new, like it's really worthwhile to do something really small and just watch what happens to it, so that you have that in your bones as far as what's going to happen if the market does X or Y or Z. So yeah, do something simple, and then once you're comfortable, then we can get into the more fun stuff about different, more complicated ways to structure it and that sort of thing. That's all.
Yeah, I mean, that's a really, really important point. So thank you, Webb. Yeah, whenever you're trying a new strategy, and it's important to try different strategies because you never know. I mean, you need to experiment and you need to try different things, but you always want to do it uh, like very small scale. So, and for me, right? I mean, I've been doing this for a long time, but I'm always trying different strategies. Sometimes they work, sometimes they don't. But you have to try. You got to try different things. Um, and yeah, I mean, I did a trade, just a one lot. If you guys remember, I started this program for limited risk reversals, and I needed to tweak it a little bit more. And I think I've got it. It's why I'm doing the presentation tonight because I'm very happy with the way I've tweaked it. But that's all. That's also like sometimes if you start a new strategy, you have some success with it, maybe some failure with it. Sometimes it just needs a little bit of tweaking to where you want it to be. And these things you learn as you're in the trade. Now it helps if, just as Webb said, you learn these things when you're risking, when you're not risking a ton of capital. But so, for example, I did a trade, and I'll walk through. I did this a few months ago. I did a trade in Square, and I was either one or two lot, and same thing. I was risking like 500 bucks. It ended up being like a $2,500 winner, and it just worked out really well. I held the call. I didn't really do anything. I think I managed it once, and so it worked fabulously. And I said, okay, Well, imagine if I would have put this thing on for like a 5 lot. And I started to do the limited risk reversals. The next few that I did them with bigger size, and they didn't work. They didn't. I ended up losing a couple. The market turns, and I ended up losing like $2,500 on one trade and $2,500 on another trade. And I thought about it, and I'm like, yeah, strategy didn't work out that well. And then I started to think about it. Well, because you put on too much risk. You didn't do it the right. You did it right with Square, and again, that's a great trade. Could I have made more on the Square by putting 10 lot on? Sure, but $500 making $2,500, that's what it's all about. And then that makes up for, and again, option trading and any trading, you've got to let your winners run. If you don't let your winners run, it's not going to make up for your losses, and you're going to have trades that don't work out. Nobody has 70-80% winners consistently. You could go through streaks where you're doing when you're hot and the market's working and you've got the right strategy on, but you've got to have those trades where you put in $500 and you make 1,500, 2,000, because you're going to have a couple that are going to be dingers. But yeah, I mean, I'll go back to like just for this, and I didn't talk about this bullet, this last bullet here. But you could kind of use this a little bit for a trend trade. What I like about this, when you're defining your risk, 1 lot, $500, 2 lot, $1,000, you're kind of the beauty of trend trading, right, is small losers. And I kind of think $500 is a small loss when you're trading options. But you're basically saying your stop is the $500. Your stop is the entry price. So it's kind of like if you've got a winner on your hands, like the Workday or the Salesforce that I've got on, you could ride it for as long. Again, some those trades are short-term trades, but if you go a little bit further out with the strategy, if you go out to September and so forth, you could still put that same type of trade on where you're selling a put spread. Now, of course, that's the one thing that's a little bit whoops. When you go further out, there's different ways that you can do this, but that when you go further out, the theta decay is not that big. So that's the only issue when you go really far out with, when you do this strategy with far out options, is that if the stock stays where it is, you're not going to lose much on the calls. You're not going to lose much. It's not really a major point regardless, because of that theta decay. If the stock stays where it is, it should balance itself out because you don't have big theta decay on the calls and you don't have it on the put spread either. The other thing that's nice about this strategy is for like a May or June option, sometimes what'll happen is, and my goal, by the way, and this again it comes into the management of the limited risk reversal, which again is important. Sometimes you could take the trade off. Going back to my spreadsheet here with a couple of these trades on. I had Apple and I got lucky with Apple. I took it off 2 days ago. That was a nice winner. But let's say you go back to this Workday one, right? Where I'm still short the put spread. The goal is not to get the put spread, for me, not to get the short put spread to mark all the way to 0. I think that's too much risk. I think if you sell something for $2.16 and it gets down to 30 or 40 cents, that's a 70-80% profit. You take it off. To try to get that last 30 or 40 cents, you could blow up the whole trade. It's just not worth it. But the beauty of it is let's say that the stock hasn't moved, right? And your call price is depreciating as well as the short put spread. Well, you buy back the put spread, you get it off your books, let's say at 30 or 40 cents. And now you're basically dealing, maybe for that last week, maybe something crazy happens and that call and the price goes up a lot. You've seen this before. A trade ends up working out at the last minute. You hold it. You don't sell the call because you basically have the call on for free. You've got a free, trade to the long side. And so you hold it in case something crazy happens, right? I mean, again, say this again, but it's the worst thing when you've got the right trade on. You take it off because you're like, oh, I'll salvage this 30 cents on the call because it's something. And then 2 days later, you know, it does what you want it to do and you don't have the trade on anymore, right? So it gives you a little bit, it kind of tricks your mind a bit into thinking what the right risk to reward is. So that's basically how I'm managing that. Is I never let the put go all the way to zero, because just like on the upside, something great could happen. Something very bad could happen too. And a trade that where you sold the put spread at what is this 216, and it's marking all the way at 30, 40 cents. Just take the damn thing off your books. And forget about that last 30 or 40 cents, because you can't. Talking about again risk to reward, the risk to reward is not in your favor anymore. You've done it. You've got a great trade. Take it off. That last 30 cents of reward is not worth the risk that something bad could happen. All right? Does that make sense? Webb, what do you think about that as well?
No, I mean you're preaching to the choir here. I'm right there with you. Like there, there's been so many times that I've been in those situations, and even with these limited risk reversals, I can't remember what stock it was, but it was a few months ago where I was looking at a full loss on a limited risk reversal, and yeah, I was looking, and it was like days to expiration, and I could have taken it off, but I'm like, they're not going to call me on it until expiration day, so I'm just going to sit on it. And then, like midday expiration day, the whole thing goes nicely profitable. The last minute.
Right.
I can't remember what stock it was, but it does happen, and that's not the first time that it's happened to me. That's probably why I can't remember it. Otherwise, it would have stuck in my memory more. But you know, there's no reason to take it off early for that loss if you're going to lose it anyway. And yeah, like if you do have one that's really long out or whatever, and you take it for the full loss, or take the credit spread off for the full loss, and you just keep the call on, why not? Like there's no reason to close the call. It's worth nothing. Like don't even pay the commissions on closing it. You might as well keep it, let it expire worthless, if anything.
Right.
So yeah, no, like you're just preaching to the choir.
It's a hard concept to learn, because everybody has option prices that, again, there's no way that you're going to have 100% winners, right? I mean, there's going to be trades, and I've done this before, and it's kind of, I'll say it, it's a rookie move. You buy an option, it's for $1, and you got 20 cents left, and you're like, well, I might as well just salvage the 20 cents. It's not a full loss. And now again, this doesn't always happen. Sometimes will go to zero. But you look at again the risk to reward. What you're taking the price. What's the point of getting the $20? There's you might as well see it all the way through. It's no point in taking something off that has depreciated 80%, and now you're going to sell it. It doesn't make logical sense. So anyway, it's a nice way. Like once you take off that put spread, you kind of feel like, well, I've got the trade on for free, or maybe a small, a small loss, and you feel a little bit more comfortable riding it or seeing it all the way through. Again, keep in mind what options do. I think also people forget about how crazy things get with odds. They're not like stocks. You've got leverage. If you get a big, fast move, that option that was priced at close to nothing, can make your day. So that's what the beauty of the option is that if you get a huge move, you've got the trade on for basically nothing, and it's going to go crazy if the option price is going to go up big if you happen to get those. Now, of course, if it's way out of money, then it's a different story. But if you're talking about like a stock that's just $1 or $2 out of the money, going into that final week, and again, it's already depreciated all. It's different. I'm not talking about like if going into the week of option expiration, and you bought a call for $1 and it's marking at $1. that's a different story. That you could decide, you could say, hey, well, I've got a full value on the call side. Let's not be stupid and sit with it all the way to option expiration and possibly lose the dollar. I'm talking about, when when the option is marking all the way down. So again, big difference there. All right. Okay. So yeah, I mean that's pretty much everything wanted to cover. Yeah, I just wanted to talk about a couple where I think the best. I always like to talk about some of the best trades that I think are on the tape. We look at so many trades on a daily basis. It is kind of a game of poker. If you're, that's why they always say, and at a lot of trading shops, they will always ask you if you've played poker a lot. A lot of the times it's very similar. You kind of good poker players, they wait until they've got a really good hand. They do a lot of folding. So when we're reading the tape all day long, sometimes it's no, I'm not going to take that hand. No, I'm not going to take that hand. I'm not going to take that one. I'm not going to take that one. So the choosier you could be and kind of sit on your hands and wait for that really good signal, often the better time. If you take every trade, if you play just like in poker, if you play every hand, you're not going to get very far. But anyway, so these three I think are very interesting. BHP is kind of sitting at my cost basis. So I will show you the trade on the tape. Webb, anything else you want to add before I start going over some of these trades?
Nope, I got nothing else to add.
All right.
It's very good.
So this was a nice trade that we saw. So I'm going actually back to Friday. So I'm using a full calendar week. By the way, Webb, thank you very much. I know you're not feeling well. Get better, feel better, and rest up.
Appreciate it. Appreciate you. Thanks everybody, and wish you all happy trading.
Cool. Thanks again. All right, so BHP last Friday, big old trade hits the tape. Right. So what is BHP? Again, this is always sometimes when I saw BHP, because I haven't traded BHP in a long time, I'm like, oh, that's a steel name. Right? And we've certainly seen a lot of steel trades, but it's actually they do a lot of other things. They do, of course, when they're listed here, it says steel raw material suppliers, but they also do, I think one of their chief business lines is steel, but their business lines are mineral exploration and production, coal, iron ore is in there, gold, titanium, nickel, copper, all these things that are going nuts right now. Nickel was up huge, I think, last night. So what a nice play on commodities. So whenever I look at one of these option trades, the next thing I do is I look at the technicals. So what's nice about this trade is they bought these for 64 cents. I think I got into this trade. I put this on for 64. I hit a target right away at 73, and it went cheaper. It got cheaper on Monday or Tuesday, which is sometimes it happens. It happens quite a lot where you can get in cheaper. And I think I even bought some for I think 48 or 49 cents. So how does this thing look? So first of all, it's pretty far out of the money. And you would think so considering that it's in August. It's got a long way away, and normally when you're playing with options that far away, they're pretty expensive. So you got to figure they're going pretty far out of the money. So let's look at the being that they're going pretty far out of the money. Let's look at they're going out to August. Let's look at a weekly chart first in BHP. And if Webb is still in there, Webb will probably like this chart a lot because it's using the value areas. So notice last week, you've kind of got this downward wedge pattern. It's above the 200 on the weekly chart. It's made this, obviously all these material names, this is going all the way back to a couple years ago, 2015, 2016, when all the material energy names, by the way, Webb, look at this, if you're still in here, look at this VPOC. Yeah, it's a nice VPOC tag. So amazing how that happens. Complete reversal on the VPOC, which is a nice side analysis. Amazing. So anyway, now fast forward to where we are now. It's been in an uptrend, but it's slowly moving and it's making some retracements. It retraced back in last year to the top of value a couple times. So it did it again. You've got your nice defined support here. Look at the nice support you've got at 43.31. Now, unfortunately, it's pretty far down. So this wouldn't be a bad stock play as well. It's not that expensive of a stock. If you don't want to trade the options, you could just buy the stock, which I'm also considering doing for the trend portfolio, for the cash trend portfolio. Because some of these you really want a lot of time, because you could see it's not a huge jumper in price over the last years, but it's been, if you hung on to this thing for a year or so, it's doubled. So again, short-term option play, no, because you got to give it some time, as they are doing, right? They're not buying Marches, they're not buying Mays, they're going out to August. Now, 55, where's 55? So it's all the way up here. It's pretty far up there. So you will need a decent move. You will need the trend to continue. How does this thing look on the daily chart? So a little bit noisy. BHP is going to have a lot of gaps in it because it's an Australian stock. This is an ADR. So you kind of have to forget about these gaps, which I know people like to look at gaps and analyze them, but it's just gappy because it trades when we're asleep. It trades in Australia. So that's where the majority of the move is going to happen. So what it's doing here, it's above this downward trend line, and it's moving above. So you got to give it time. So a way that you could play this is those August calls, and you're going to need a big move. And if it makes a slow move, it's going to be, it's going to be a tough trade. But you need it to get all the way to 55. So I prefer a stock trade at this point. Now, it could move. I mean, certainly some of the areas that it's in, copper's picking up, nickel, which I don't have on Thinkorswim, but their business segments seems to be a good stock to be in right now. So again, you could structure it any way you want. That's what they did. I'm in them. I keep selling a little bit when it got to 70 cents, which my cost basis was around 52. I took a target. If it goes back to 50 cents, I'll buy a little more. You could do that with an August position because you're going to get dips. But copper actually came in a little bit today. So anyway, that's trade number one. I like that trade a lot. Again, I think cash or options. And again, you could pick a closer to the money option if you think 55 is too far away. Again, always good to foot this strike price to the chart to see if you think it's reasonable that it's going to get there based on what the stock has done before. Now, it could accelerate faster if these commodities keep going up. I would think BHP would be pretty levered to that move. Certainly, we've seen what Alcoa has done. Just quickly, KWeb, I thought this was really nice. We don't see much option flow in the Chinese internet ETF, but I did take a trade in this, and then I kind of looked at the technicals. Nice size trade again, $1.5 million in option premium. So we're messing with some nice stuff. So somebody's thinking that the Chinese internets, which are kind of on their knees a little bit, the KWeb is sitting at this 200-day moving average. What I would think is so there's two different things that stand out to me. It's kind of caught in the middle. You've got your nice support of the 200-day moving average. If it breaks the 200-day, I think you kind of have to abandon this idea. But there's no real buy signal yet either. There's no confirmation. I've talked about confirmation in a number of end of day videos that I've shot before. Confirmation, I think, is this thing getting into value or getting above the, maybe the 20-day moving average. So you're kind of taking this trade with a grain of salt that it's going to pick up and it's going to hold support, but clearly buyers haven't really stepped back in. Weekly chart, I think also, maybe even better on the weekly chart. Wait for this thing to get above 61. That's your top of value. I think that would be pretty good. And this thing's already marking down since I got into it. I think it's marking around like 335 or 340. So keep your eye on it, even if it gets above because probably the volatility has come out of this thing a little bit. But if it gets above 61, you may be able to spend the same amount than what they paid because a couple days has gone by. So what I do for a lot of times, if I'm not in a trade or if I want to add to a trade, add bigger size, a lot of times I start a position like I did in this, and I wait for some confirmation to actually add wait for the stock to actually go up to add. So I put an alert, and I put an alert above 60. I think I put an alert at 61.25, and that would be my confirmation that buyers are coming back in. All right, so that's number two. Number three, DVN. DVN, what a huge winner, my goodness. But this kind of has a fold to it, or a wrinkle to it. They bought these May 37 calls for 52 cents. As I said, when I took the trade, have to be comfortable with that whole 52 cents being a loss. And day one, this thing marked down to like 45 cents, I think. And I even said, hey, it was like, hey, if you're not comfortable, it's not doing anything. This was on Monday, this trade went up. And on Tuesday, I was whining about it because all the other energy names were performing well and this one wasn't. So I was like, I was like, great. Somebody bought 8,000 of this and the thing's not doing anything. Well, it went up to, DVN went up to, what, $1.70? I think is where I took that last target. And it's now above the 200-day moving average. So again, I took it, it was below, I called it a counter trend trade below the 200-day moving average. Now it's back above the 200-day moving average. So anyway, so then what did we see after that today? So I took the majority of that trade off because it's such a short-term trade for May. I was in either, I think, a 20 or 25 lot in DVN, and I stripped it all the way down to like a 3 lot. Literally hit 3 or 4 targets yesterday. And then today, what do they do today? They bought all these October calls. All right, so I think what they'll probably do is they will, usually when this happens, they roll out of their short-term position, take their profits, for $1.50 or $1.70, wherever this thing's marking now, and then they buy a further out strike. But they didn't take it off yet. They took some, I think, off today of the Mays, but they didn't take the whole thing off. So what I did was I got out of the residual position of my Mays, and I put the Octobers on. And the Octobers is 40. So again, like that trade, it's got plenty of time. Clearly, this thing can move when there's, was a huge day for it yesterday. So again, now I'm messing now with the house money in this new trade, this October trade. And I'll do the same thing like I was talking about with BHP. If it goes down a little bit, leave myself plenty of room to kind of add on the dips, and kind of manage it all the way through. All right, everybody. Any questions? We'll kind of wrap it up. We've gone a little bit over an hour and a half, which is basically a long time for a webinar. Thanks for joining me tonight, but by all means, I'm here to answer any questions. This was mainly a member webinar. I didn't really advertise it. I basically told people, if you can't make it, I always record it so people can watch it at their leisure. How can you tell how much they took the position off? Well, so originally they bought the 7,000 of these May 37s. Well, actually, they didn't trade. I thought this was the 37 strike. I thought this might be them taking it off, but no, they didn't. They didn't take any of it off yet. So they still got all the Mays on as well. What I normally do is I check open interest the following day, but you could see they didn't trade them today, so they did not take off the Mays either. The 37 strike. All right. So that was one question. I always plug the what we do in the room every day, but I've started to I've added the private Twitter feed, which I think is really cool. But anyway, I think we've got a really good concept going on. We've got a great trading room. We've got really some great idea generation. And I'm sending these stuff out now, which I think is much better than the text alerts. Now I can kind of just explain what I'm doing, and I think it's so much better. And plus, the alerts come quicker too than the text messages. But I broke down this trade today, AAOI, which I think is a pretty high risk trade. I just traded this in stock because the option prices are so expensive. But basically way below the 200-day moving average. This is a counter trend trade. But look at this thing, get above the 50-day moving average. It popped above the 50-day moving average here, settled in a few days, and went again. So, this one I think you have to have a tight leash on because it's a volatile sucker. But I think it's worth it's worth a shot. We talked about the FCX flyer as well, which is working. But again, very nice to be able to send this out, and a little bit of detail behind it. So anyway, TribecaTradeGroup.com. Go there. $7 for the first week. All right, guys. Have a great night. Thank you for joining me, and hope to see you guys in the trading room. Have a great night, everybody.